welcome to this week's edition of Money Matters TV. My name is Doug Hepburn, and with Hepburn Financial Advisors, offering securities and investment advisory services through Cetera Advisors, LLC, member FINRA, SIPC. Cetera is under separate ownership from any other named entity. I'd like to introduce my guest host today, Ken Jordan from Round Point Mortgage. Ken, how are you?
Very good, Doug. Good to see you again.
Good to see you too. Tell me something good in your world these days.
Well, I'll tell you what's good is there's still an awful lot of people that want to get mortgages. That's a good thing, right?
Exactly. Yeah. And can they still get them at decent rates?
Well, they can. And that is the good news. I mean, rates have increased over the last couple of months, and we're still kind of caught in the unknown of where they're going to land ultimately. But from a historical standpoint, we can't be upset with where rates are in the global scheme of things. I think that the real challenge, though, right now is not, the rate, although rate does affect affordability. The real challenge is supply. There's still just an absolute limited number of houses available to buy, which is continuing to drive up those sale prices. So increasing sale prices from a buyer perspective is a much bigger problem than the increase in interest rates.
It's funny that you mentioned that. I spoke to a friend yesterday who said that their house was listing today, and they already had 12 people scheduled to go through and look at it. And I have a lot of
real estate partners that are saying the same thing. They list the house. It's selling for 25, 35, 45, 55,000 above the asking price, and there's multiple offers, multiple bids. It's a real challenge for homeowners. It's a real challenge for buyers that don't have the ability to buy cash.
Right. I can see that, and if you have to move and you have some place to go, that's great. But if you're selling at an inflated price and buying at an inflated price, you're almost, 6 of one, half dozen of the other.
True.
So, it's sort of tough to get a good deal out there.
The only people that benefit from an environment like this are people who are selling for the last time.
Right.
You, for whatever reason you're going into a rental, this is the last time you're going to sell. If you're buying and selling right now, not the end of the world, because like you said, you're buying at a premium, but you're selling at a premium. Exactly. The folks that are entering the market right now are the ones who are really, having the toughest time because they don't have a property, not taking advantage of the premium pricing on anything else. And that continued, supply crunch is there's only a couple things that are going to change that, Doug. One is the lack of buyers. I don't see that happening, right? Because you look at the supply and demand curve, the demand's not going to go away due to a lack of buyers. The only way we're going to affect this is if the supply and demand curve is impacted on the supply side. Right. And I was talking to a guy the other day, I was reading an article that said that 1 in 7 homes, single family homes, is owned by a hedge fund. The hedge funds have been buying up single family homes left and right, which of course is decreasing the amount of homes that can be bought by individuals and hurting the supply. But I guess let me ask you a question, Doug, with that, what is the benefit to hedge funds buying single family properties?
Well, traditionally, most investment companies, obviously, they want to make money. Mm-hmm. So they're going to do it in one of two ways, either through interest, dividends, rents, or through capital gains. And generally speaking, when you buy real estate, it's an illiquid asset, so you're not going to see a whole lot of fluctuation in values because, it's not like stocks that get repriced every millisecond.
Right.
They get repriced maybe, every month, every 3 months, every 6 months. So it has a tendency to be stable in portfolios, but it also generates revenue. At some point, the hedge funds are going to say, hey, look, we need our money back because we want to redeploy it somewhere else. And the question becomes, when is that going to happen? And how quickly are they going to let this inventory back onto the market?
So it's safe to say that, one of my concerns, as a professional in the industry is that, if, let's say a big hedge fund decides, we're where we need to be. We're going to start putting some of this inventory back on the marketplace, and other people kind of look around, They're doing it. We're going to do it. Could we possibly see a massive influx of inventory quickly over a short period of time?
That's a good question. In my mind, I think you would think that hedge fund managers would be a lot smarter than that, than to be affected by negatively by crowd behavior and all jump on the bandwagon and move at once. So I think you're probably not going to see a lot of distortion from the selling. It's just going to allow more units to come onto the market and more people to buy. I'd be curious to know whether a lot of those homes that are owned by hedge funds are entry-level homes, for first-time home buyers, because that's been, as you said, people buying homes for the first time, they're the ones who are having to pony up a lot of the extra money because there's not a whole lot of inventory out there. And if you're young and coming out of an apartment, chances are you don't have a whole lot of down money to go out and do a cash offer. So it sort of makes things difficult, but I can see how having institutional investors would disrupt the market.
And I think if you just kind of look at the numbers and say, okay, well, if I'm a hedge fund, I'm purchasing a property, I'm going to want to purchase a property in a price range where the fair market rent that I'm going to get for that property results in a profit. I think the higher you get on the purchase spectrum, price wise, the harder it is to get a rent that's going to be profitable. So you're probably right. It probably is a number of, entry level price points that is being purchased by the hedge funds. And those should be the ones that do make their way back onto the market. And hopefully it is done in a somewhat organized fashion, so we don't see any kind of a crash. But ideally, if it happens, it's really the only way to impact supply right now, considering that building homes is still very difficult right now. There's still a ton of supply chain issues in the construction world. And how else can you increase supply?
Exactly. And, the same is true in the multifamily sector. Apartments are booming everywhere. You see them going up everywhere. And I think that's in part because of the lack of supply for first-time home buyers. Mm-hmm. The interesting thing from a philosophical perspective is, home ownership has been a core tenet of capitalism and people's ability to build equity. And so when you have institutional investors that are taking out these first-time home buyers, it kind of limits people's ability to build that equity. And that's really more of a difficult situation akin to a socialist economy.
We could talk about that for a full 30 minutes, couldn't we?
Exactly. So, but it's good. We got a good question for you. Okay. And so we got a question from John Marks in Philadelphia, who wants to know, what is principal curtailment in a mortgage document?
Well, principal curtailment, in by definition, is a reduction in the amount of the principal owed on the loan. Not to be confused with a recast, where if you have a chunk of money, let's say that came from the sale of a house, and you want to submit that or send that money into your mortgage company and have them re-amortize your payment, that's called a recast. Typically, principal curtailments are come about when let's say you do a rate and term refinance, and your estimate was off and you end up walking away from the table with more money than you're allowed. They'll do a principal curtailment, they'll reduce the loan amount, won't change your payment. If you're doing a renovation loan and you have your construction costs plus a contingency reserve and they don't use all that money up, again, they'll do a principal curtailment and then they will reduce the loan amount without changing your payment. And then the third reason you might say principal curtailment is as a loss mitigation factor. Like, for instance, if you were in financial trouble and you reached out to the mortgage company, they're able to put together some sort of a modification. Principal curtailment is one of the options that they could use to give you that loan modification, decrease what you owe, and potentially even re-amortize it in that case.
Interesting stuff. I'm sure our viewers appreciate that because, it's not something that we get into a whole lot. Thanks for that question. So I'd like to introduce our guest today, and that's Nick Yzzi of Canon Capital. He's a CPA, former IRS agent, and since it's tax season, I'm sure he's got a lot of great advice for us. How you doing, Nick?
Hi, Doug. Thanks for asking me to be on the show.
Oh, my pleasure. So, last year, I guess for all of 2021, we heard about this whole Build Back Better plan and, what that's going to do. And I know a lot of people made a lot of crazy tax changes thinking the estate tax was going to go nuts and get changed all over. What do we see that happening at all?
Well, that's hard to predict, Doug. At this point, there are renegotiations starting to assert themselves again. I know President Biden and Joe Manchin have recently met. I think it would have been 2 days ago. A lot of different things could happen. I mean, we don't know if this is just completely dead. We don't know if it's going to be broken up into smaller bits. Whether I would think that maybe the name of the bill might be changed. Some rumors there. I would think we're going to have some legislation because there's surely needs for some of the things that are in the bill. And there's a lot of controversy between the two parties as to whether it's just a tax incentive type plan to change our system or whether it goes beyond that with a lot of environmental issues. So I think that's the gist of a lot of the controversy.
Right.
I would think it's going to get scaled down. Obviously, it started at $3.5 trillion. It got scaled down to $2.2 trillion. Joe Manchin, who was the Democrat who sort of put the next to this whole thing, wanted a $1.75 trillion. But he also wants to address the $30 trillion debt that we're looking at, which is a significant problem. So we don't know where it's going to end up. I mean, surprisingly, they didn't change brackets a whole lot. The way it stood at its last presentation was that the top bracket was going to go from 37% to 39.6%. So that doesn't impact most taxpayers in the country.
Right.
So that was a good thing. But they did want to increase the long-term capital gain rate from a maximum of 20% to 25%. They wanted to expand the net investment income tax, which is right now is based on passive income. They wanted to include things like Subchapter S earnings, which really could impact the viability of S corporations.
Well, we even had one senator who wanted to tax unrealized capital gains, which is
some crazy ideas like that. That would have been horrible.
Thanks. I think that's a very accurate description of that.
So we don't know where it's going to end up. I would think, surely the administration wants to have something out there prior to the midterm elections. So I would think we're going to have something, whether or not it's the similar package to what it was, but just scaled down with revenue dollars. But it remains to be seen. But I think we'll have something before it's all over this year.
Quick question, Nick. Well, first of all, welcome.
Thank you, Ken.
You spent some time with the IRS, so you kind of have a good understanding of the inner workings. With regard to the tax filings from 2020, I know there's a huge backlog. People are unable to get through. They're unable to get their returns filed. What can you give us some insight as to what's going on with that?
Yeah, it's really created a problem for a lot of people because not only just the taxpayers who may do their own returns, but also practitioners. They have about 8 million unprocessed paper returns primarily from 2020 that are still sitting there. There's 5 million pieces of correspondence. And when we try to resolve issues, you get a notice from the IRS and then you respond back. It sits there for months. I just had one where I sent a letter in November. I just got the letter the other day and it said they need 60 more days. I sent certified mail that it will take 3 to 4 weeks before it's even presented for signature back. And there's a variety of business returns that are unfiled as well. There's amended returns that are unfiled into the millions. You're familiar with the employee retention credit. There's payroll tax returns, 941Xs to claim this credit. There's 402,000 of those returns that are not processed yet. So the IRS has admitted that this coming tax season could be pretty difficult for everyone involved. I don't know if that will produce another extension like we've had for the past 2 years because of COVID-19. But I suspect that could be the problem if the backlog continues the way it is. So the point there is to try to file electronically whenever possible and don't send any paper because they are backlogged. They're trying to detail people from other positions to be able to catch up on this backlog that they have right now. They've just recently transferred 1,200 people from their regular position to to be able to assist. Obviously, they're trying to hire more people. That hasn't happened because, particularly in the Build Back Better plan, they wanted 80,000 IRS employees, many of which would be auditors. They haven't done a whole lot of examinations for quite a few years. Not that I'm complaining about that. That's nice. But so it's quite a mess. And to be honest with you, you have to give them a little bit of credit because they were assigned a lot of responsibility when it came to
Oh yeah.
all the COVID related things, the PPP loans, round 1, round 2, the
And then they were all
recovery
working
rebate
remotely.
credits, 3 of those, and then the advanced child tax credits last year, which is going to create another mess this year. So they've taken on a lot of work without more employees. A lot of employees have retired. They haven't been replaced. And as you know, in the business world, it's hard to find employees right now.
Oh yeah.
So they're experiencing the same dilemma that everybody else is out there. So it's not all their fault. I think they're doing the best that they can with the resources that they have.
Nick, I don't think you're going to find a whole lot of sympathy for the IRS in our audience, but I guess you pretty much explained.
I just try to give them a little bit of credit, but I can say other things, but I'll reserve that for myself.
You know, hey, look, they're human beings. They're doing their job, and just like you and me, they just have a different role.
That's right.
Although, you know, from a fact perspective, I mean, I spoke to a client last week who said that the IRS couldn't deal with their return because it was in a tractor trailer in Ogden, Utah. So they've got all these paper returns that are sitting in tractor trailers and they can't process them yet.
Correct.
And so, you know, it sort of makes it tough for them to sort of work through. And at the same time, you've got the big computer at the IRS that just loves to spit out notices. What do you do if you're a taxpayer and you're getting noticed out the wazoo? I mean, you know, a lot of these things are time sensitive. And if you don't respond within 30, 60, or 90 days, you know, you're subject to some significant penalties.
Yeah, I mean, the notices kept rolling, and I had that specific situation with a person who had a 30-day, 60-day rollover from an IRA. He replaced the money in 30 days. They ended up sending him a notice for $86,000. Sent a letter. Obviously, the letter sat somewhere for a couple months. And then he gets a final notice of intention to levy. And he's a licensed individual, which creates a problem. So we had to intervene as best we could. Obviously, taxpayers have a different resource to go to. We have a taxpayer advocate that we can contact, so I'm able to put a hold on that. But for the regular taxpayer, that's really difficult because you call and you can't get through, and you get these courtesy hangups because the lines are so backed up. And in that case, I think you need to hire a professional to be able to handle it for you, because you're not going to be able to get into the right people to be able to at least put a hold until all the correspondence issues have been resolved. There is something on the individual line you can do, and that's called you can contact the taxpayer advocate, and there's a form 911, which is like an emergency form for someone who could be severely hurt by any of the intentions of the IRS.
Right.
But I think you're better served just dealing with a professional who does it all the time, because the ball keeps rolling. And unfortunately, when they want something, you have to respond immediately. And when it's just the opposite, when you want something from them in the form of correspondence that you've sent, and you don't get an answer because it is sitting in a tractor trailer. So the best thing is to be able to just contact a professional. Or another alternative is, if you sent numerous pieces of correspondence, you could always contact your congressman. And that's called a Congressional Inquiry. And when you do that, IRS has to respond to that congressman in a limited number of days. But oftentimes that won't produce an answer. It'll just put a hold on what your accountant may do if you had an accountant.
Right.
So that's the best advice I could give at this
So
point.
it kind of stops the clock from ticking, right?
Yeah. Now, they did come out recently, and they said they've canceled some automatic notices, like that intention to levy notice, a CP 504. That one's been canceled right now until they address the backlog. And there's been some other ones as well. So Congress has gotten on them as well for this tremendous backlog, because they're getting all these congressional letters from people that can't get it resolved.
Oh, I'm sure.
So they're getting their offices filled with all these phone calls and letters. So it just continues to just dribble down, and then eventually it goes back up to the IRS commissioner.
So what's someone to do then, Nick? I mean, if they make a legitimate error or mistake, and all of a sudden they're getting hit with these penalties, what recourse do they have to go back and address that?
Yeah, if you make an innocent mistake, and if you had good compliance history, there's something called a first-time abate procedure. And they can remove penalties for failure to file, failure to pay, failure to deposit payroll taxes. That would be some of the basic tenets of where you can qualify for first-time abate. As long as you didn't have the issue or the lateness in prior years, then it's almost an automatic procedure. Otherwise, you have to file an appeal usually to determine whether you're eligible for removal of penalties for not being negligent, not purposely disregarding the rules and regulations, but that's a little bit harder to do. And if you're doing it on your own, it makes it more difficult. But this first-time abate procedure, if someone has a problem with a penalty, then look up first-time abate. There's an Internal Revenue Manual text that you could use, and it is almost automatic as long as you have good compliance history.
So the IRS actually gives mulligans?
Yes, they do. Yeah.
Oh man, God, who'd have thought that?
Yeah, they. Sometimes it depends on who you get on the other line too.
Yeah,
Absolutely.
So when you call, you have to be nice. You don't want to agitate the
Yeah.
person on the other line.
Hey, as my grandmother always said, you can get more bees with a spoonful of honey than you can with a cup of vinegar.
That's right.
Now, you mentioned previously how the IRS has been burdened with all these, stimulus credits, tax credits for child tax credits. How is that playing out? Because a lot of people don't know that, some of these things are refundable. Some of them are really just an advance refund of, their tax payments, and it's going to be adjusted on their tax return. Can you address that?
There's two letters that IRS issued recently. The 6419 addresses the child tax credit. So if you received advance payments, which started last July, and so that was an advance payment on your 21 tax return. The problem is people got this money. It wasn't very well communicated that was an advance. So people are going to file their tax returns this year. And if they receive those 6 advances on their child tax credit, and that credit's $3,000 for a child ages 6 to 17, it's $3,600 for someone under 6. They're going to be a little bit shocked when they realize they're not going to get that credit because they've already gotten half of it. So that's not going to be the credit they expected. So the IRS sent out letter 6419 to tell you what advance payments you received. And then with respect to the recovery rebates, they also sent out letter 6475. And that was the third round of rebates that started in March of 2021. That letter will tell you what the rebates were that you received. That would have been $1,400 for each taxpayer in the family. Some of those notices aren't 100% accurate. IRS says that most of them are. But that's a letter that you should supply to your accountant so that he can reconcile. Those things have to be reconciled in your 21 return to make sure that if you were overpaid, you have to pay it back. And if you were underpaid based upon your current income qualifications, and then you might be due a credit on your 21 return. Okay. So that's another thing that the IRS has to deal with. And obviously, if you don't put the correct numbers on the return, now it creates correspondence. And then the correspondence theoretically can sit in a trailer again. Exactly. So you need to get that return correct the first time and not have to go through this, because seriously, on a lot of these notices, accountants can't even charge back all the time they put into it because that time may be more than they put into doing the return. So it's been quite a mess. The other problem with these rebate things is when they first came out, they were issuing, some people were getting direct deposits, some were getting checks, and some were getting debit cards. They weren't clearly marked, so people thought they were like solicitations from credit card companies. They threw them away. So we do the return, and they said, "Well, no, I didn't get a rebate." And then IRS says, "Yes, you did." So the return changes, and it creates correspondence. So that created another mess as well last year, and I expect the same thing will happen for the coming tax year.
So make time to do it right, or make time to do it twice, right?
Correct.
So let's shift gears now to saving money, right? Favorite thing of taxpayers when they hire a CPA is how can I save money? And My question is when a person reaches 72 years old and they're required to do their, required minimum distributions, what are ways they can save on taxes?
I think one of the best ways, Ken, is to, if they're charitably inclined, is to do what's called a qualified charitable distribution, because obviously that when you reach age 72, used to be 70 and a half, now it's 72. You have to take out your required minimum distribution based upon your the actual mortality tables. So if they're charitably inclined, what they should do is have the money transferred directly from the IRA into the charity, and that won't be taxable. And that has a couple other beneficial effects. Since that transfer goes directly from your IRA to charity, it doesn't increase your adjusted gross income. And for a retired person, that has a couple different effects. It may help you with the amount of medical expenses you're able to deduct, because that's a function of adjusted gross income. You're limited to deducting 7.5% or the excess of 7.5% for medical expenses. So your AGI will be lower, therefore your medical expense would be higher. But something else that people get hit by is that it's called IRMA. People who are age 65 and over who are on Medicare, their Part B supplement ranges from $170 a month to $578 a month, depending on what their adjusted gross income was 2 years prior. So I get people frequently who say, "Hey, my premiums for my Part B Medicare have increased dramatically," and that's because they're now taking out distributions from their RMD that they weren't expecting, that would increase their what's called the income-related monthly adjusted amount, the IRMAA. But it's basically a function of your adjusted gross income. So if you're given the charity, take the money out of your IRA first. To the extent that you can. You're allowed to do up to $100,000 a year per taxpayer. But even if it's lower amounts than that, it could be 10 or 20, take it out of there and it'll give you a couple different benefits that maybe you weren't expecting.
Very cool.
Great stuff. Yeah, it's probably good for people to work with their CPA and their financial advisor to sort of fine tune that, to make sure that, they get enough to get themselves under the limits and for the next bracket. And of course, under that next threshold for IRMA, because if you're $1 over that, your premiums go up significantly. It's not like it's phased in.
Yeah, it really impacts the cost of medical care.
Yeah.
Some people think that CPA stands for cleaning, pressing, and alterations, and I think that's a misnomer.
Good stuff. Good stuff. Well, the final thing that I was going to ask is, I know we talk a little bit with clients about doing backdoor Roth IRAs, and for a while there, I know they were the Obama administration wanted to curtail that. It sounds like they've approved that, and the IRS is not challenging it anymore.
Yeah, a backdoor IRA, it's an interesting concept because it's not really codified in the Internal Revenue Code, but it's allowed by the IRS. And basically what it is if your adjusted gross income is too high to allow an IRA contribution, which you can do, and for an IRA contribution, your AGI can't exceed $280,000 for a married filed joint return.
And that's fine, Nick. I hate to do this. We got to wrap up.
Okay.
But the fact is, you're allowed to do backdoor Roth IRAs.
Backdoor Roth IRAs, but there are some pitfalls. If you have traditional balances, you need to make sure, because that backdoor Roth IRA technique could backfire if you have other balances in your pre-tax traditional IRAs.
Exactly. Good stuff. Ken, Nick, thanks for joining us today.
Thank you very much.
It's been a great show. Our next guest next week is going to be Bill Morrison, MD, FACR, or the musculoskeletal imaging at TJ Hospital. And again, thanks for joining us at Money Matters TV, where your money matters.